It's December 31st, closing time at Maple Bean Coffee, and your barista Lena just finished a full shift. But payday isn't until January 9th, so here's the puzzle. Whose expense is Lena's day? December's or January's? Hold that thought, because it gets worse. Chapter 2. Left you with a warning. Your books say supplies $4,000. Walk to the closet and count. There's nowhere near $4,000 in there. Tonight we fix both problems with the same tool. Adjusting entries, the heart of accrual accounting. And every chapter in this course is built on one sentence. Learn that sentence and the rest is detail. Stay to the end and I'll hand you Chapter 3's. But first, let's catch the books lying. Here's the uncomfortable fact about that beautiful trial balance you built in Chapter 2. It's officially called unadjusted because some of its numbers are quietly wrong. Not because you journalize badly, because of two facts of life. 1. Some expenses are never recorded daily. Nobody journalizes every paper cup. You'd need a bookkeeper stapled to the counter. 2. Some revenues and expenses are still completely unrecorded at year-end. Supplies used, insurance expiring, the machine wearing down. And this matters because real people read these statements. A banker deciding on your loan, a supplier, you. Books that lie mislead them all. Quick reassurance before we start. Everything tonight stands on one old idea from Chapter 2. Debits grow assets and expenses. If that's fuzzy, the refresher is linked below. If you own it, you're ready. First, the quiet assumption underneath this whole chapter. A business is one long, endless movie. It might run 50 years, but nobody waits 50 years to ask, how are we doing? So accounting slices the movie into episodes. Months, quarters, years. That's the time period assumption. Artificial slices cut on purpose. A year that runs January through December is a calendar year. Any other 12-month slice, say July through June, is a fiscal year. And the moment you slice time, one question rules everything. Which slice does each dollar belong to? Two ways to answer it. Accrual basis accounting, required by U.S. generally accepted accounting principles. Records revenue when the performance obligation is satisfied, the work is done, and records expenses when they're incurred, not when cash moves. Cash basis accounting records revenue only when cash comes in, and expenses only when cash goes out. No receivables, no payables. Sounds simpler, and it produces misleading financial statements because it doesn't match expenses with the revenues they created. Test both on Lena's shift. Cash basis says the paycheck is January's, so it's January's expense, and December's profit looks better than it really was. Accrual basis says the work happened in December, so December pays the bill. Accrual tells the truth. That's why generally accepted accounting principles demands it. That truth-telling runs on two principles, and I want to go slowly here because these two lines quietly carry the whole chapter. Principle 1. The revenue recognition principle. Recognize revenue when it is earned. And when exactly is it earned? The moment the service is performed or the product is delivered, not when the customer pays. Think about it at Maple Bean. A customer can pay you early, pay you late, or never pay at all. None of that changes the accounting. The revenue belongs to the moment you did the work. Full stop. Principle 2. The expense recognition principle, better known as the matching principle. Match each expense to the period where it helped generate revenue. December's rent matches December's sales. Lena's December hours match December's coffee. Every expense sits right next to the revenue it helped create. Baby version, December's work goes on December's bill. No borrowing from January, ever. And keep these two sentences close. Every adjusting entry you're about to meet is just these two principles, enforced. So, where does this fit in the machine you already run? Chapter 1 gave you the equation. Chapter 2 gave you the pipeline. Analyze, journalize, post, unadjusted trial balance. Now comes the new station, adjusting entries. Journalize them, post them, and out comes the adjusted trial balance. And from that, the financial statements. Now, two golden details. Screenshot material. Golden detail 1. Every adjusting entry pulls at least one account from the income statement and at least one from the balance sheet. Both reports, every single time. Golden detail 2. Courtesy of every examiner who ever lived. Cash is never in an adjusting entry. If you ever see cash inside a so-called adjusting entry on an exam, it's wrong. Full stop. You now own the two fastest error detectors in accounting. All adjusting entries belong to one family with two branches. Here's the map. Branch 1. Deferrals. To defer means to postpone. The cash moved first, and the recognition waits. You already paid, or you already collected. But the expense or the revenue isn't recognized until later, when it's actually used or earned. Two types, prepaid expenses and unearned revenues. Branch 2, accruals, the mirror image. To accrue means to build up. The revenue or expense happens first, quietly building up, and the cash moves later. Two types again, accrued revenues and accrued expenses. And here's the difference that unlocks everything. A deferral already has an originating entry in your journal. An accrual has nothing written down yet. Hold those two words, postpone and build up. And let me show you the deferral movie in slow motion. Watch the deferral pattern happen twice. Pattern 1. Supplies. Day 1. You buy paper cups. Debit supplies, credit cash. Look at the timeline. Cash already moved, but nothing is an expense yet. The cups sit in the closet, an asset. Months pass. Customers come, cups get used up. So, on statement day comes the adjusting entry. Debit supplies expense, credit supplies. Recognizing only the amount you actually used. Cash first, expense later, that's the postponement. Pattern 2. A gift card. Day 1, a customer hands you money. Debit cash, credit unearned service revenue. A liability, because you owe the coffee. Weeks pass, you pour the drinks, then the adjusting entry. Debit unearned service revenue. Credit service revenue, recognizing only what you earned. Cash first, revenue later. Same movie, two endings, and the exact Maple Bean numbers are minutes away. Still with me? Good, because this next family pays the bills on exam day. Deferral number 1. Prepaid expenses. When you pay for something that benefits more than one accounting period, you don't record an expense. You record an asset called a prepaid expense, or a prepayment. Wait, paying for insurance creates an asset? Yes. Think of your fridge. You don't cry expense the day you fill it with groceries. You own food you'll eat all month. A 12-month policy is a fridge full of protection, something you own with future value. That's Chapter 1's definition of an asset. It becomes an expense only as it gets used up. Now, the star of the Chapter 2 tease, supplies. Through the year, Maple Bean bought $4,000 of beans, cups, and filters. Originating entry each time. Debit supplies, credit cash. So the ledger proudly says, supplies $4,000. But nobody journalizes a paper cup as a customer walks out. It's impractical and unnecessary. Instead, on December 31st, you count the closet. $1,100 of supplies still on hand. Now the famous algebra. 4,000 minus x equals 1,100. Solve it. X equals 2,900. That x is what accountants call the plug. The supplies used this year, $2,900. You'll write it in the entry in a second, so say it once more with me, 2,900. Used. Let's derive the entry. Never memorize, always derive. Which accounts? Supplies expense, an expense, and supplies, an asset. Which direction? The expense grows, the asset shrinks. Now Chapter 2's rules. Expenses grow on the debit side, assets shrink on the credit side. So, debit supplies expense, $2,900. Credit supplies, $2,900. Watch it land in the T account. Unadjusted balance, $4,000. Credit, $2,900. Adjusted balance, $1,100. Exactly what's in the closet. And notice the double move. Straight off the expanded equation. The expense account goes up, while owner's equity goes down. Expense up, equity down. Revenue up, equity up. One income statement account, one balance sheet account. Golden detail 1, delivered. What happens if you skip that entry? Count the lies. Expenses are understated, so net income is overstated. So owner's equity is overstated, and assets are overstated too. Because supplies still claims $4,000, that isn't there. One missing entry. 4 wrong numbers on the statements. This "what happens if we skip it" question is a certified exam favorite, so we'll answer it for every type tonight. And a pattern from my teaching days, students who could write the entry perfectly still lost points here, because they never practice naming the damage. You'll practice. Same movie, different actor. On October 1st, Maple Bean paid $2,640 for a 12-month shop policy. Originating entry, debit prepaid insurance, credit cash. That's $220 of protection per month. By December 31st, 3 months have expired. October, November, December. 3 times $220, $660 used up. Adjusting entry, debit insurance expense, $660. Credit prepaid insurance, $660. What's left? $1,980. 9 months of protection, still an asset. Prepaid rent works identically. Rent paid in advance, then expensed as it expires. But catch the difference in how they expire. Supplies expire through use. You count a closet. Insurance and rent expire with the passage of time. You count months. Same family. 2 different clocks. Now the big one, the concept that separates this chapter's A students. Look at Maple Bean's counter. the $6,000 espresso machine from Chapter 1, plus the brewer you added in March, $9,000 of equipment. Here's the puzzle. The supply closet visibly empties, but the machine is still there. No visible reduction at all. It just quietly loses its ability to produce over the years. Like tires on a car, still round, still on the car, quietly wearing out. So fixed assets, also called plant assets, or property, plant and equipment, are really a long-term prepaid expense. You paid once, and it earns revenue for years. Matching says, spread that cost across every year it works. How much per year? One formula. Annual depreciation expense equals cost minus salvage value, divided by useful life. Salvage value is what you expect the asset to still be worth when you're done with it. For maple bean, cost $9,000, expected salvage $1,800, useful life 6 years. $9,000 minus $1,800 is $7,200 divided by 6. $1,200 of depreciation per year. $1,200 every year for 6 years. And one absolute rule for exams: land is never depreciated. Unlimited useful life. It doesn't wear out, so there's nothing to allocate. Machines, buildings, brewers, yes. The ground they sit on, never. Time for the entry, and a genuine plot twist. The debit is easy. Debit depreciation expense, $1,200. Now pause for 3 seconds and predict which account takes the credit. If you said credit equipment, that is the single most common wrong answer I ever graded, and it feels completely right. But we don't touch equipment. We credit a brand new kind of account, accumulated depreciation. Equipment, it's called a contra asset account, an asset account that lives on the credit side, built to offset its partner. So, debit depreciation expense, $1,200. Credit accumulated depreciation, $1,200. Why this detour instead of just shrinking equipment? That question deserves its own slide. Crediting accumulated depreciation instead of the asset is the appropriate, preferred approach for 2 reasons that both protect the reader of your statements. Reason 1, it preserves the original cost. Anyone opening the book still sees equipment, $9,000, what you actually paid. Reason 2, it discloses the total cost expense to date. Watch it accumulate. That's literally its name. After year 1, $1,200. Year 2, $2,400. Year 3, $3,600. A running total over the asset's whole life. And keep this sentence for the exam. Depreciation is an allocation process, not a valuation method. Nobody is claiming the machine is literally worth $1,200 less. We're matching costs to the years it earns. Put the pieces on the balance sheet. Equipment, $9,000, less accumulated depreciation, $1,200. Equals $7,800. That number has a name, book value, also called carrying value. Cost minus accumulated depreciation. And it continues, Chapter 1's cost principle story. Here's the warning label. Future portfolio manager. Book value is not market value. They answer different questions. Book value answers, how much cost hasn't been matched to revenue yet? Market value answers, what would a buyer pay today? A 5-year-old espresso machine might sell for more than its book value, or less. The books don't care. Allocation, not valuation. Own that distinction, and this whole section is yours. Back from the break? Perfect timing, because now the money flows the other way. Deferral number 2, unearned revenues. In December, Maple Bean sold $1,500 of holiday gift cards. Cash in hand. Feels like a win. But is it revenue? Not yet. You haven't poured a single coffee against those cards. Chapter 2. Met this account for 1 line. Now it gets its whole scene. Originating entry, debit cash, $1,500. Credit unearned service revenue, $1,500. And that account is a liability. Cash created a debt? Yes. You owe the work. A gift card is a promise in plastic, a debt payable in lattes instead of dollars. Until you perform, that money isn't really yours. It's a customer's claim sitting in your register. By December 31st, customers have redeemed $900 of those cards. Coffee poured, work performed. You've earned your way out of part of the debt. Adjusting entry, debit unearned service revenue, $900. Credit service revenue, $900. The liability shrinks to $600. Real revenue appears. Skip this entry, and the damage mirrors the prepaid mistakes. Liabilities are overstated, revenues understated, net income and owner's equity understated. Notice the mirror, because it's beautiful. Prepaid mistakes flatter your profit. Unearned mistakes hide it. Same family, opposite lies. And if you're still here and following, you're doing better than most of my classroom ever did. Branch 2 of the family, accruals. And they're sneakier. Everything so far had an originating entry. Some cash moved, something got written down. Accruals have nothing. The revenue or expense already happened, but at the statement date, the books are completely silent. No entry anywhere. Silence feels safe. It isn't. The adjusting entry is the first time the event is ever recorded. Two types, and Maple Bean has both waiting tonight. Work you've done that nobody has paid for, and work done for you that you haven't paid for. Let's collect what you're owed. Accrued revenues. Revenues for services performed, but not yet received in cash or recorded. On December 29th, Maple Bean finished a $750 catering job for an office party. The invoice goes out in January, but the work is December's. Derive it. Your claim against that customer is an asset. The finished work is earned revenue. So, debit accounts receivable, $750. Credit service revenue, $750. Interest works the same way. Money owed to you that accrues with the passage of time. Debit interest receivable, credit interest revenue. And if you skip this adjustment, everything understates at once. Assets, revenues, net income, equity. The books hide value you already earned. Then January arrives, and the office pays its invoice. Watch this entry carefully. Debit cash, $750. Credit accounts receivable, $750. Now look again. There is no revenue line anywhere in it. It's a swap of assets. Your claim simply becomes cash. And here's the trap I watched catch students every single semester. At collection, no new revenue. It was earned in December when you did the work. January just collects it. Count it twice, and your revenue lies. The mirror image, and the home of our hook, accrued expenses. Expenses incurred but not yet paid in cash or recorded. Think of a tab quietly running at someone else's counter. Two classics. Salaries your crew already earned. Debit salaries and wages expense. Credit salaries and wages payable. And interest on a loan. Maple Bean borrowed $6,000 on November 1st at 8% a year. The formula, interest equals the loan value times the annual rate times the time in terms of 1 year. 6,000 times 8% times 2/12. November and December equals $80. Nobody has billed you yet. The bank's clock doesn't care. Adjusting entry. Debit interest expense, $80. Credit interest, payable, $80. $80 of December truth. Now let's pay our oldest debt. The hook. Maple Bean pays salaries every second Friday. The last payday was December 26th, already in the books. But Lena works Monday the 29th, Tuesday the 30th, and Wednesday the 31st at $150 a day. 3 days, $450 of work that December received, and payday is January 9th. So the answer we promised, it's December's expense, cash or no cash. December 31st. Adjusting entry, debit salaries and wages expense, $450. Credit salaries and wages payable, $450. December now carries its true cost and a true debt. The books tell the truth, even about a paycheck that hasn't happened yet. January 9th arrives. One check, $1,500. Watch the entry think. Debit salaries and wages expense, $1,050. That's January 1st through 9th, the New Year's own work. Debit salaries and wages payable, $450. Paying off December's debt, an expense that was already recorded, never a new one. Credit cash, $1,500. One check, 2 stories, part new expense, part old debt retired. And notice the payable did exactly its job. It carried December's cost across the year-end line, then vanished when the cash finally moved. That's accrual thinking in a single entry. And it's the entry where this chapter clicks for most students. Journalize all 7 adjustments, post them, and build the adjusted trial balance. And this time, let's put the real one on screen. Every account at period end. First, the assets, cash, receivables, supplies, prepaid insurance, equipment. Notice supplies now says 1,100, the closet number at last. Next, the liabilities and equity. And look, accumulated depreciation, salaries and wages payable, interest payable. The accounts born tonight, all in gold. Then revenues and expenses, including 4 expense accounts that didn't exist this morning. Now the totals, 44,920 equals 44,920. Debits equal credits. The same test you learned in Chapter 2, passed after every adjustment. From this trial balance, and only this one, we prepare the financial statements. Now the payoff, future CFO. Watch what the truth cost. Before adjusting, revenues, $21,000. Expenses, $11,000. Net income, $10,000. After adjusting, revenues, $22,650. Expenses, $16,290. Net income, $6,360. Profit moved $3,640, and not $1 of cash moved with it. Champagne on hold. But every banker, supplier, and partner reading these statements now gets the real story. The books tell the truth. That was the whole point tonight. One more tool. Because some companies journalize deferrals backwards, on purpose, and both ways are legal. Quick demo with next January's numbers. Small on purpose. The convenience method. Buy $1,000 of supplies and debit supplies expense immediately. Credit cash. Then it's statement time. Count what's left. $400 on hand, and the adjusting entry flips the unused part back. Debit supplies, $400. Credit supplies expense, $400. Supplies expense ends at $600. Exactly what was used. Revenue side, same trick. Collect $800 and credit service revenue immediately. If $300 is still unperformed at the statement date, flip it. Debit service revenue, $300. Credit unearned service revenue, $300. Different road, identical destination. Both methods always land on the same numbers. Here's the complete map. The whole chapter on one screen. Deferrals, prepaid side. Supplies expense over supplies. Insurance expense over prepaid insurance. Rent expense over prepaid rent. Depreciation expense over accumulated depreciation. Deferrals, unearned side. Unearned revenue over revenue. Accruals, revenue side. Accounts receivable over revenue. Accruals, expense side. Salaries expense over salaries payable. Interest expense over interest payable. 8 patterns. 1 page. Every single one pairs an income statement account with a balance sheet account, and not one of them touches cash. Freeze frame this before any exam. Then prove you can rebuild it from the 2 branches, cash first or recognition first. Before the promised card, the exam map, because this chapter shows up on tests exactly 3 ways. Form 1. Compute the adjustment. Supplies used. Insurance expired. Depreciation. Interest. Form 2. Write the adjusting entry. Form 3. Name the effect of skipping it, which statements lie, and in which direction. That's it. Every Chapter 3 exam question is one of those 3 in a costume. We drill all 3 in the free mock exams at appliedanalyst.com. Link below. And now, the promise kept. Chapter 3's one sentence. Adjusting entries make the books tell the truth about when. Each one pairs an income statement account with a balance sheet account and never touches cash. Say that sentence in an exam hall and the chapter unfolds from it. The full card is on screen right now. The family tree, every entry pattern, the depreciation formula, the effects of skipping. Pause and screenshot it. Keep it in your camera roll. It's the whole chapter in your pocket. Your turn. Pause the video. Question 1. A delivery van costs $5,400. Salvage value, $600. Useful life, 8 years. What's the annual depreciation expense and the adjusting entry? Question 2. Maple Bean forgot the adjusting entry for $1,300 of gift cards that customers actually redeemed this period. What happens to liabilities and to net income? Pause now. Ready? Answer 1. 5,400 minus 600 is 4,800 divided by 8. $600 a year. Debit depreciation expense, 600. Credit accumulated depreciation, 600. Answer 2. Liabilities are overstated by 1,300, and net income is understated by 1,300. The books look more indebted and less profitable than the truth. Got both? That's real accounting, future CEO. Be proud of it. That's Chapter 3, the chapter that separates bookkeepers from accountants. But one loose thread remains. Your revenue and expense accounts measure one period. December's story shouldn't leak into January's. So how do you reset those counters to 0 for the new year? Without erasing history, there's a special kind of entry for that with a satisfying name. Closing entries. That's Chapter 4, where we close the books, literally. Before you go, one last problem, and I'm not solving this one. On September 1st, a company pays $8,400 for a 12-month insurance policy. Write the December 31st adjusting entry. Work it on paper. The full worked answer, plus free notes, free exercises, and free mock exams. Lives at appliedanalyst.com, link in the description. Subscribe so Chapter 4 finds you. And if anything felt fuzzy, tell me exactly where in the comments. I read every single one, and I answer, usually the same day. Every expert you admire once said exactly where you are. Keep pushing. Future CPA. The only difference between you and them is the next chapter.